As the financial markets come to grips with Trump's on again, off again, then on again stance on tariffs, we begin to see things break in the markets, giving us early warning signs that the bull market is coming to an end. But a bull market coming to an end does not mean that the top is in. We're seeing several signs that we're beginning to form significant lows. We're seeing signs that the markets want to hit new all-time highs. And we're also seeing signs that investors want to get heavily into risk on assets yet again. So in today's video, I want to go through several of these key early warning signs for the end of the cycle running into this peak with risk on assets and show you how to apply it to your own trading and investing portfolios. So let's kick it off with a like and subscribe. Thanks again for your support here on the channel. It really does go a long way to helping out the channel and more people seeing how this end of the peak, end of the cycle is all coming to fruition. We're going to start with the US dollar and Bitcoin in the early part of the cycle, 2010, 2011, then again in the background here for 2018 or 27 into 2018. Again, we had it in 2020. And a smaller one here for 2022 into the early part of 2023. And just recently, we had a very significant breakdown for the US dollar. So it seems like there is a bit of confidence being lost for the US dollar. And how this relates to BTC is what we've seen in history, what we've seen in the past, is the Bitcoin price skyrockets when we get a significant breakdown for the US dollar. That's not the only time that Bitcoin has gone up in this history. We have to remind ourselves that Bitcoin has only been in one stage of the 18-year cycle. You might hear me reference this quite often. We're looking at large real estate and economic, essentially business cycles relating to the US economy, starting from the bottom, running 14 years up with two distinctive halves of 7 years each, and then a rough 4 to 6 year decline. Of course, the cycle roughly runs around 18 to 20 years. And the decline that we're forecasting to come up after this peak is going to be much more severe than what we've seen at any time since roughly 2009 through to 2012, where we had that the low for the economy. So that's the big one that we're now tracking leading into this peak. What typically happens in the second half, so we have here the second half of the cycle, is we see a decline in the US dollar. So we're currently in the second half of the cycle, and the US dollar has not put in a new all-time high. And that alone can give enough ease to risk on assets like BTC. And of course, Bitcoin has been going up through this period. Yes, with some drawdowns of 30%, 20% through the period. Of course, nothing goes up in a straight line. But the main thing we're following here are the sections of the easy run with the big breakdown for the US dollar, and then periods where the US dollar is consolidating, whether that means consolidation for a move higher or whether it's consolidation for another attempt lower. Either way, the US dollar is not necessarily in a strong trending market. We have one recently through 2023 and 2024, pretty well sideways through this period. One move to the upside, which was a fake out. And now we're seeing the US dollar decline from this point. So that's the first of the early warning signs leading to the end of the cycle. The US dollar comes down in value. Now we can take a look at this on a longer term time frame. So we can check back to previous cycles. It's always nice to have more than one history or one data point within history. And the previous mid cycle was back in 2000, 2001, which led into the stock market low of 2002. And for the US dollar, you can see a peak here from 2000, tested it again 2001, then another little top here in 2002, essentially all at the same level at about 118, 119, and then a very significant collapse from that point. So the second half of the real estate cycle going back yet another cycle. So this is the 20 years ago, 20, 25 years ago. Let's go back again to roughly 40 years ago. And the decline in the second half, again, pretty severe decline there for the US dollar, starting somewhere around 126, 130, and declined into that low that began the following cycle. Following cycle started around 1992, 1993, and then ran up for that 14 years into the peak of about 2005 through to 2007, where we look at real estate, the economy, and of course the stock market then, which topped in 2007. So each of these times, going back 40 odd years, it looks like we're in the midst of another one here. And with the US dollar declining, well, that generally leads to an easing on prices for commodities and risk on assets. And here we are with BTC also showing some signs of further upside. Historically speaking, the bull market must continue while we see these easing in prices for the US dollar. But eventually it comes to an end and you start to see the US dollar basing out, putting in a consolidating pattern. Last cycle, you got 2008 into 2012, 2013. That's where the that's where the gold price topped, and that's where real estate bottomed. So let's take a look at that now. We have the gold price topping in 2011, started to run down into that first significant low in 2013. And at that time, it's a good place to flip from gold or these assets that have been running up through a period where the market was quite uncertain into a longer term outlook or a longer position here, say for something like real estate, where you can start to get a return on that investment at lower prices. And through that stage of the cycle with real estate going up, you're also seeing other assets continue to go up. In this case, you've got gold also increasing, but you're not getting a return on that, and you can get bigger gains elsewhere. Just like with the stock market, where you're looking at a low for the stock market in 2009, yes, they both ran up together, but then gold came all the way back to that price of where the stock market lowered. So you start to miss out on some pretty significant gains if you're not flipping in the long term from the macro picture from one significant asset to the next. Now, some people are going to choose real estate, others are going to choose the stock market. It really comes down to your personal opinion. But of course, you're here on the channel, you might be interested in Bitcoin. Bitcoin's only been through the bull market of the 18-year real estate and economic cycle. So it's going to be interesting to see how the next phase plays out for BTC. Is it going to follow the path of something like gold, which eventually goes up for a short period of time through the uncertainty of the recession or global depression? Or does it follow something more like a risk on asset, which goes down through this particular period? Either way, when the cycle does turn down over this next 4 to 6 year period, taking it out to roughly 2029, 2030, it's going to be important to watch which assets are going to be stronger through this period and which ones are going to be weaker, which ones you need to flip back into at an earlier stage. This is the period where investors are trying to find which asset is going to lead the way out of the low of the next cycle. And like we've seen with previous cycles, that could be a basing, the first signal there, a basing of the US dollar, then it could be into stocks, gold, real estate, and then watching for which one of those assets is going to break into new all-time highs first. This is Bitcoin's first cycle into that period. And as the market confidence for Bitcoin and cryptocurrencies begins to return, as we can see with the market sentiment, looking at the crypto fear and greed index, rising into the greed, of course, over the last few days, falling back into neutral. It's going to be important not to get swept up with too many different news headlines that we may see with the changing market sentiment from extreme fear into something like greed or extreme greed. At the tops, we often hear lots of news articles coming out about anything to do with why the market can't go down this time, why things are different, maybe even what we see on social media, why TA doesn't work. Those things I often see come out close to the peaks, if not at the tops. Like we saw last time around December, January, the time was TA can't work. This is a different cycle. We have a crypto president. They're buying Bitcoin, so on and so forth. And it's something different that the media says to us, whether that's social media or traditional media at those peaks, saying why it has to be different. Nevertheless, it's never different. Things rhyme and you start to see a decline after that. So that's the second of the early warning signs, looking at market sentiment and essentially the media as well with those headlines. Now, in terms of something objective with the market sentiment, I love to use the crypto fear and greed index. And along the history here that we've got for the crypto fear and greed index, there's often periods where it runs into this extreme greed, and that's the time to get onto high alert, those early warning signs that we could be seeing a corrective move coming. That alone isn't enough of a signal to say that this is the end, because of course the market can last in extreme greed for quite a considerable amount of time, and of course price action is king. So it's important to keep watching that price action into that top. But nevertheless, That is the second early warning sign as we start to run into this greed period of the market again. Further upside obviously brings on more eyeballs, brings on more excitement. And of course, with that extra excitement brings on more emotions, more FOMO comes back into the market. As a trader and investor, it's important to have an open mindset. Could we be wrong? Could the peak already be in? So I'm always looking out for signs to tell me, is this top in? Are we too focused on this end date of 2025 or 2026? So I'll come back to the charts and have a look at where these price ranges are. So we're looking for a land cycle peak, like we saw in 2005, 2006, and then a land-led recession. So a decline in real estate prices. That's the theory that I hold in regards to the cycle. While the land market continues higher, while we see higher prices, while there's still stability in the market, then it's almost unlikely, or very, very unlikely, that the stock market has topped, and is going to collapse. Therefore, risk assets probably have some further upside to go. And we're still seeing that. Although small gains, we're still seeing further upside in real estate prices across the US. So this is your national home price index. The latest reading for February 2025 is at 335. That's the same high as July 2024 and June 2024. They're only slightly above it, but we've got an increase now. The trend has turned up again since those lows of late 2024. And if you want even more on top of that, you've got the Redfin data, LA also hitting the same top as back in the middle of 2024. So at $925,000 for a median sale price. Now the national is still heading up, 431,000, getting very close to the previous all-time high of June 2024, and it's now equal with the May 2022 top, which is basically the post-COVID boom that we saw back in, well, 2021 and into that peak of 2022. So you're still seeing these higher lows form, higher highs are beginning to break out again for some of the majors around the US. And in some areas, they're just getting closer to that new all-time high. So just watching the national average as well as these prices continue to tick up. So the third early warning sign that we're looking at for the bull market peak is, of course, the real estate cycle top. And as we saw with the previous cycle, 2005, 2006, real estate prices topped. And it's not like a stock market that shoots straight up, straight down at some peaks, or runs up slowly, peaks, and then you see these severe drops that happen in the stock market. Like the old saying goes up the escalator, comes down in the lift. These tops often take some time, and then they also take longer to produce that low. So that low at the bottom can take several years, 2009 being one of the first lows. Then you had another low 2011, lower low 2012, higher low 2013, and it can feel like forever. It can feel like we saw in the early 2010s and late 2000s, it felt like it was never going to come out of this low. Fortunately, the cycles are suggesting that we're a long way from these lows, and there is further upside to be had in this cycle. Michael's done a fantastic video on the risk on side of the market, something that we're probably heading into right now. I'll leave a link to this video in the video description, so go and watch that next. And if you want to take your investing more seriously towards the peak of this cycle into the correction and scooping up some of those gorgeous bargains at the lows, check out TIA Premium. We have a sale starting today for the next 72 hours only. Link to this is also in the top of the video description. I'll see you guys at the next video. Thanks again for joining me here. Like, subscribe, you know the deal, and I'll see you at the next one. Take care. Peace out.